Good morning, and welcome to the webcast. This is our second session for the virtual 2020 Building Opportunity Conference from Moss Adams, providing insight into current challenges facing companies operating in the built world. Over the next few weeks, we are hosting several sessions covering topics such as how COVID-19 is shaping the landscape of cities and infrastructure, economic impacts of newly passed bills, business planning in an election year, and post-election tax planning and considerations. More information for each session, including registration details, are available in the links provided in your resources widget here on On24, as well as on mossadams.com. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you. And now, let's get to our session this morning. The shifting economy, capital markets, and commercial real estate. I am pleased to introduce both today's host, Kelvin Tetz, partner and national practice leader for real estate here at Moss Adams, as well as our special guest presenter, Ken Rosen, chairman at the Rosen Consulting Group. Let's turn things over to Kelvin to get us started. Kelvin, the floor is yours.
Good morning, everybody, and welcome to part 2 of our virtual conference for 2020. Yeah, it's been an interesting year with a lot going on, and Ken does a really good job of explaining to us all those things that are happening, et cetera, et cetera. So thanks for joining. And before we kick it off to Ken, we got our first polling question coming up. Pretty simple one here. What property type are you most interested in learning more about today? A, industrial, B, multifamily, C, office, retail, hotel, all of the above. Kind of a softball here. We're going to hold this open for a little bit, try to get as much of you as much time as possible to keep that going. Getting close. So a little bit more. If you're out there and you want the CPE credit, let's get these answers in. All right, and the results. Thanks, Gerald. Here we go. Looks like it's spread all across the board. And with office, multifamily, industrial kind of leading the charge on the individual property type. So thanks for that. And with that, I'm going to hand it off to Ken.
Thank you, Calvin, very much. And I really appreciate the opportunity to be here again and talk to the Moss Adams clients. As you know, there's a lot of uncertainty out there, and so I'm going to start with a view of where the macroeconomy is and what it means for real estate, and then delve into capital markets, and then into more detail by a few of the property types. So where are we today? Well, we've lost over 21 million jobs in March and April, and unemployment rate soared to over 16%. But from May through now October, we've gained a lot of jobs back. Again, we don't have the October numbers yet, but through September, we've gained back about half the jobs we lost. But it's a very bifurcated economy, sort of like the K recovery, that certain parts of the economy are doing quite well, whether it be tech and finance. High-income workers, only 3% lost their jobs. But low-income service workers who work in hospitality and restaurants and a lot of the service jobs, personal service jobs, have been lost. And so they've lost more jobs and are being hurt badly by this recession. We have two major initiatives coming out of Washington trying to provide medication. Because remember, the economy was put in a coma by government action, shutting us down to try to stop the virus. And now, even though we're reopening, people still have fears about the virus, and of course for good reason, since we've hit record numbers of new infections and hospitalizations this last week. But the two streams of aid we've had have been first aimed at consumers, a fiscal stimulus. A one-time check came in April and May, $1,200 a person. But more importantly was the supersized unemployment compensation, where we gave $600 per week extra in federal money on top of state money. We also expanded it to include self-employed people, gig workers, and the like. So this pandemic supplement was very important. Unfortunately, it expired at the end of July, and we have, so $600 a week is now $300 a week extra, and that is from FEMA funds, and that will expire shortly. We unfortunately did not get a new bill through Congress, as was expected the last couple of weeks. So there's going to be a gap here with unemployment compensation falling quite dramatically, especially the special stuff that people are getting. So that worries us some. No question that either when Congress comes back after the election or certainly by January, there'll be another attempt to provide this unemployment compensation, which is critical for people to pay their rents and live successfully. And about 25 million people are on various forms of unemployment compensation. Equally as important has been the Federal Reserve's activities, where they've basically, starting in April, lowered short-term rates close to zero and have bought long-term bonds and mortgage-backed securities, and through the TALF program, lots of other things, including AAA CMBS. And so they've stabilized the financial markets and pushed long rates down to roughly 80 basis points, a 10-year bond, and short rates close to zero. And they said they're going to keep this for the next 3 years. So that has really stabilized financial markets and has certainly helped the for-sale housing market. But the pace of recovery, and that's going to be my theme throughout this, depends on the virus. We've reopened the economy without virus containment. And so we've seen a new surge of cases here, especially in some parts of the country. And we're really worried we may have to shut down again to contain this, as has happened in Western Europe and other places. So there's a lot of uncertainty. On the positive side, places like China, Taiwan, New Zealand, South Korea, and Australia now have been able to reopen and successfully contain the virus. But there's just a lot of uncertainty. I call it radical uncertainty. And so we'll have to wait and see. The next slide just tells us some of the impacts, if we can go to the next slide, on real estate. And each part of the real estate market has been differentially affected. The industrial market, warehouses have done best of any commercial real estate category. Trade flows are up year over year. and e-commerce has surged, and that's really the main thing to say. People have reduced purchases at stores as they've been closed. Now they're reopening, but e-commerce has been the big beneficiary, and that means warehouses, where fulfillment comes directly from the warehouse to the consumer, bypassing the store. I also think there's going to be structural shifts here as we try to move to a just-in-case inventory system rather than just in time, and remove the supply pipelines closer to the U.S. rather than just dependent on Asia. So I think warehousing, booming now, probably continues to boom for some time. A big sector of the market that you're all interested in, of course, is the apartment market, the multifamily market. And large job losses would normally have led to a free fall in the apartment market. And especially in some of the coastal metropolitan areas, we have seen that. We've seen outmovements from coastal metropolitan areas to less dense suburban locations or other metropolitan areas. We've also seen 2.5 million young households move back home with their parents. So that's really hurt those coastal markets. We've had a moratorium on evictions throughout the country and in many localities for some time. That ends for most places in January. So the worry is that people who don't have the income, don't have the unemployment compensation, are behind on their rent. What's going to happen? Right now, as of the latest numbers of October, 92% of rent was paid a year ago, 90% paid this year. So it's a little bit of reduction. But I think the big issue here is the unemployment compensation being withdrawn or not stopped. Until we get that back in place, I'm quite worried that we might see basically November, December, January numbers look worse. The out movement numbers, again, surprise people because working from home. And maybe that's where we ought to go next, the office market. The office market, the main thing of happening there is that we have had people working from home. The occupancy in places like New York and San Francisco is 10, 12%. So very low occupancy as people are working from home and have been now for 8 months. Places like Dallas, we're seeing bigger occupancy, 40, 50%. But the fact is there a structural shift in the office market where there'll be more flexibility, we'll cut the office footprint as more people decide to work from home or allowed to? We already see some impacts of this with a third of sublet space availability. And I'm going to show you that chart later, especially in some of the coastal areas. So that is a big issue. For retail, a large sector of real estate, but we've seen basically here many bankruptcies of retailers, over 25 big companies, and we've accelerated the retail shakeout that was already underway before COVID. And so at the moment, we do have, again, the retail sector, especially the mall sector, experiencing lower payments of rent. And the issue is here, once COVID's solved, I think we'll see a recovery, but it may be a partial recovery because the e-commerce channel continues to dominate. Hotels, as travel bans have taken place, people aren't traveling internationally at all. We've seen a plunge in occupancy, especially in the gateway cities and international hotel markets, convention cities, global gateway markets. But we have seen some recovery in the local travel market, still weak compared to where it was a year ago. If we move to the next slide, we see that the one sector that's done especially well is for sale single-family housing. The main reason for this is that we've had people want more space as they're working from home and want less density. And millennials, the trend was already moving this direction, decided to really take the plunge now, helped by the lowest mortgage rates we've ever seen. Residential mortgage rates are down 100 basis points and below 3% in many cases. At the same time, we see about 7% of borrowers, because of loss of income or loss of job, asking for forbearance and not paying their mortgages. So this is a bifurcated economy, but there are enough people in the top half of the distribution who are leading to a boom in for-sale single-family housing. The commercial real estate capital markets we've seen here is for retail and hotel properties, rising delinquency rates, and eventually I think will be foreclosures. Cap rates, there haven't been many transactions, but if we were to look at this carefully, we think retail cap rates are probably up. Multifamily industrial cap rates are probably down, some, especially industrial. A number of the open-ended funds have actually suspended, have redemption queues, so they really can't make all the redemptions requests they have. And I think patience and extension and forbearance are really the key in these markets. This is a COVID-produced recession. If we tame COVID, the recession will be over. But it may take a while for the structural damage to be repaired. So if we can now switch to the next slide, just to show you, we have basically almost 20 million people on continuing unemployment claims. Huge numbers of people still depend on this. And so that's why the sharp cut in unemployment compensation, because of the expiration of the bills that aid we've had, is going to cause a secondary slowdown over the next few months until we get that restored. The next slide just shows you employment growth, how we had the two huge drop months and now a big recovery. Very different than the last recessions, which were caused by excesses in the economy. This was caused by a coma-induced government shutdown, and the reopening has led to a substantial recovery. But until we tame the virus, we won't get full recovery in a number of sectors. The next slide just shows you geographically, we've lost jobs everywhere. There's no one who's gaining jobs, but less of a loss in the southeast and southwest mountain states, as those places were already gaining growth as the coastal metropolitan areas lost jobs continually, out-migration to those locations. We do all of our work by metropolitan area. We have detailed reports, as the next slide shows you. And so this is just ranks cities by the metropolitan areas by the least job loss. Every one of these cities are losing jobs, but less so. And I think it's notable that low-tax metropolitan areas in Texas and Florida have done very well. But we've also seen places in the West like Phoenix and Denver attract people from California. And as we look at the bottom of the chart, you can see that California cities, New York, San Francisco, Oakland, Orange County, LA, lost a lot of jobs. Also, gateway cities with things like Disney World, Orlando, of course, lost quite a lot of jobs, as you can see. So we've had a very big loss in gateway cities, and in some of the very strong low-tax, low-density environments, less job loss. The next slide shows you something that is not surprising, but secondary cities have done better. Boise, Idaho if there's a winner of all this, it's Boise, Idaho. But cities like Jacksonville and Kansas City, San Antonio, Salt Lake, Nashville, where people are moving already, again, lower cost of doing business, in many cases no income tax, much lower cost of housing. Next slide just shows you the bifurcation. That, again, as I mentioned, low-income service jobs, big losses, high-income tech and finance jobs, very small losses. And the next slide just reiterates this, that by education level, again, least educated have gained back half their jobs. Highest education level people have lost very few jobs, very consistent. The next slide just shows you small business. Small business has been hurt badly by this. 18% of small businesses are still closed, but that's down from 60% at the peak. So again, more openings happening, but lots of structural damage has been done. The industry most affected by this, the next slide, is the restaurant industry. And we can see that everything shut down completely in late March and April. As we've reopened now, it's still down 42% from the peak. Indoor dining is still not at full capacity in many places. That's the blue line. The green line is Germany. Germany had contained the virus, and by late summer, it was back to normal in terms of outdoor dining and dining total. But now the recurrence of the virus has led to a sharp drop again. So the virus is really the story. And the next slide just shows you the hotel market. And the hotel market, same thing. We've had partial recovery, especially in the low-end drive-to economy sector, but we have not had recovery in high-end convention and gateway cities. Retail sales, the next slide, just shows you the surge in e-commerce. E-commerce has been growing 13, 15% a year. But obviously the last 8 months have led to a huge surge in sales and e-commerce outlets, and Amazon, of course, the biggest beneficiary there. Next slide shows you something that might not have been expected, but the surge in home sales as people have decided to move to more suburban locations, own their own place, low mortgage rates, and desire for more space and less density. Next slide just shows you one sector that has been damaged a lot, of course, is commercial real estate. We're going to talk in more detail about that, but especially the mall, hotel, office, and apartment sectors have been down 20 to 50%. Overall, REIT market is down 14%. And it may mean some of the best values in real estate today may be in the apartment REITs and office REITs that have been so beaten up. So we'll now switch to a polling question.
All right, time for our second polling question. Just as a quick reminder, once you check the box, please hit the submit button to get that processed. And it's changed slightly since the draft proposals, but how many cities have experienced positive employment growth year over year in 2020? A, 1, B, 2 to 5, C, 5 plus. And if you were paying attention, I think it was about flat versus a little bit up for Ken's presentation. And so, check the box, hit the submit button for CPE credit. And then as a reminder, we'll go through the slide deck and have time at the end for some Q&A. Please submit your questions through On24, and we'll get those addressed at the end of the formal presentation. So we're about 78%, a few more people here. If you want to get credit, get those, and here we go. So yes, 50%, won, as Boise, Idaho was talked about. So next slide.
Thanks. So again, a week ago, Boise was positive. Now it's not. The numbers keep on coming out. So the next slide just gives you our summary economic view, or where we are. And if you look at the bottom of the slide, this shows you the quarterly numbers. Huge drop in the second quarter, rebound in part in the third quarter, and then slow recovery over the next 2.5 years. This assumes two things. It assumes that we do not shut down the economy again in the next 3 months. That's a pretty big assumption given the surge in the virus, but that as one assumption. And the second assumption is that we get a vaccine in the first half of 2021, and we get widespread distribution by summer. Because that is, again, the key issue. We've got to contain the virus. It also states here, and I think correctly so, that we continue to add back the jobs as we reopen. But certain sectors can't fully reopen until we get travel back and the virus contained. So certain sectors are going to lag behind. The Fed keeps rates low through this environment, but we do think the 10-year bond might edge back up as recovery takes place in the economy. Next slide just shows you our path to recovery. It's a stair-step U, and it does take 2.5 years. It doesn't happen instantly. I wish it was going to be a V, but I think it's unlikely until we get the virus contained. And the risks, the next slide just talks about the risks. And the virus is still the risk. If we shut down again, that can put the economy back in reverse. We also have the election, we all know, coming up next week, next Tuesday. And we have a contested election that would cause, and delayed results that would cause lots of problems. And it's possible we could get something like a blue wave, which lead to dramatic policy shifts, both positive for some and negative for others. So we'll have to watch that carefully. The U.S.-China trade dispute continues to simmer, and U.S. relations with China continue to be almost like an economic Cold War. I think that's a mistake. China's our second largest trading partner. We really want things to go well, and it certainly thinks that maybe after the election there might be some breakthrough there. We've had obviously a lot of problems in some of our cities in terms of a surge of crime, and again that has been an issue that may have pushed some people out of urban areas. At the state and local levels, we've had huge revenue shortfalls because of the COVID-induced recession. We need to make state and local governments whole. Otherwise, there's going to be lots of layoffs there. And the way to do it is not tax increases, which is what's happening, but we need to have some of the fiscal stimulus directed at state and local governments, and I think that's a necessary part of the new package. I do think that when all this is said and done, we solve the pandemic problem, economies in recovery, we're saddled with something that we haven't seen before. The debt to GDP ratio has risen dramatically, and the bond market repression is not the right strategy when we recover. So we might have a messy unwind in the bond market. Instead of being 80 basis points 10-year Treasury, it'd be a 3% 10-year Treasury. And that volatility might cause some, several years down the road, some pretty big issues. I do think there's still the issue of what I would call deglobalization. We started 3 or 4 years ago, and it's happening here and other parts of the world. Trade restrictions, immigration restrictions, the free flow of capital and people has been really the big advantage that we've experienced in the U.S. with globalization. And villainizing globalization, I think, is a mistake. So the next slide, we're going to do some capital market stuff, and then we'll get to real estate sectors. Next slide just shows you the extent of the very sharp drop in interest rates. 11 basis points on the short end, 81 basis points as of a couple of days ago on the long end. These are extraordinary low rates, back to where we were on the short end during the Great Recession and recovery. Fed has decided to repress rates, but the long bond is much lower. And probably the single most important thing on this call is the long bond is incredibly low. Now it's time to lock up your financing for real estate as these rates probably won't go much lower, can't go much lower. Next slide just shows you what we call the yield curve, and you can see here it's we can advance the slide so we could see it. The next slide shows you the Treasury bond yield curve, and it is not advanced on mine, so I want to make sure there it is. Great, and very flat on a year ago, somewhat upward sloping now, but 100 basis points, roughly 100 basis points lower on the long end, and 140 on the short end. The Fed has told us, the next slide, that we have extremely low rates for a long time. Each dot, there's a dot there. You can't really see them. Those are dots, those blue dots, are Federal Reserve Board members and head of local feds. And so they're telling us, they give us this every quarter, they're never going to raise rates in the next 3 years. Don't believe it. Lock up your rates. Be ready, because I think they don't know. And look at their longer run view. Rates should be 2.5%, which I happen to agree with. Rates are too low given where inflation expectations are. But they're doing this to stimulate the economy. And the next slide just shows you how they're doing this for the long end. It's the huge increase in the balance sheet. We were at $1 trillion in 2008 with QE1, QE3, QE2. We got to $4.5 trillion. We'd been reducing the balance sheet till last September. Now the balance sheet's $7 trillion. So this is really what they're doing. They're repressing rates. They're holding beach balls underwater. Take advantage of it. Grab that money while you can. And the real rate of interest, the next slide, just shows you it's negative. And over the long run, it averages plus 2%. So this is an extraordinary moment to be a borrower against your sound real estate assets. And it is because of the next slide, which is the central bank intervention. We haven't seen this almost ever in our history, where the central bank's share of the economy rises so dramatically. This is intervention that normally would cause howls in Washington, but it hasn't. So our long-run forecast is basically the long-run bond we think will bounce back next year as the economy recovers. It is dependent on the recovery, and that's the dotted green line. The market doesn't think that. So if you wanted to, instead of locking up long-term money, if you want to just do a hedge using capital markets, very inexpensive to do now. And I know that the Moss Adams people can help you along with your bankers. Next slide just shows you what worries me. The budget deficit is out of control. It was out of control before this started. In 2019, we had $1 trillion budget deficit, even though we had full employment. We never should have been at that level. That is I would say, complete lack of intelligence on the part of the Senate, the House, and the President. A $1 trillion deficit at full employment made no sense. Well, now it's a $3.1 trillion deficit going to maybe $5 trillion. And we're going to pay for this at some point. And the next slide just shows you that this is out of control. And if we go one more slide, the best measure of this is the debt to GDP ratio. This would normally be considered unsustainable. And yes, we had to stop the Great Recession here, but it's because of the virus. It's not because of government policy, and we have to aid people to get them through this. But we're going to have to pay that debt off at some point and get the ratio down. When interest rates get back to 3%, how do we finance this? Inflation, the next slide, is something people always worry about. And inflation at this time is relatively contained. It's about 1.7%, the latest numbers seen, which is below the 2% target for the Fed. But look at the last 3 decades. Inflation has really been in the 1 to 5% range. It doesn't matter if it's 1, 2, or 3, or 4. It makes no difference. So I think that the bottom line for this is forget about this. Look at asset inflation, and that's a problem. So I think we go to the next is a polling question before we get to commercial real estate capital markets.
All right, time for our third of 3 of 4 polling questions. What are your expectations for changes in cap rates? And it may be very, as Ken mentioned earlier, it's all over the board depending on the property type. But just curious as to what people think is happening with cap rates. A, decrease 25 to 50 basis points. B, no change. C, increase 50 to 100 basis points. D, increase of, I think that's supposed to be 100 basis points plus. Or E, I'm not sure. So go ahead and fill that in and check the submit button. For CPE credits, we're right about 60% complete. If you want to get that in, now's the time. Thank you very much. Just a few more seconds here and we'll close the poll. Getting close. Here we go. All across the board, which is kind of what we'd expect, I think, based upon what we're seeing in the market so far. So, Ken, next slide.
All right, so
let's go.
We've done the cover slide, the commercial real estate slide, so let's switch to the next slide. And cap rates were at record lows entering this COVID period. And again, all over the map, but if you were in high-quality institutional properties, cap rates were in the 4 to 5% range. But if you were in secondary markets, secondary property types, might be in 6+% range. But cap rates were very low entering this. But if we look at the next slide, it really differs by sector. And I used the public markets to get an implied cap rate. Public markets, stocks, REITs, have moved quite dramatically. So what we see is that the cap rates for manufactured housing and industrial properties are the lowest, and they really haven't moved at all in this environment, maybe even slightly down. Single-family rentals haven't moved at all. But apartment cap rates, at least in the public markets, have moved up about 100, 150 basis points. CBD office, the same thing, about 160 basis points. And the biggest move up, of course, has been in retail, where people are feeling uncomfortable. The biggest move down has been in data centers, and that's, again, a small sector. And the biggest of all moved up, of course, has been malls, giant move. But if you skip to the next slide, you'll see that cap rates relative to treasuries were actually pretty high entering this. So even though real estate values are going to drop because of NOI dropping, they're not going to drop because cap rates are going to surge. Even though the public market says they're surging, what it really is the NOI drop that we're seeing in at least the perception of it in retail, some CBD office, and some apartment markets. And so the next slide just shows you data through the third quarter. That the two sectors that have been marked down through NACREIF, and this is, again, an appraisal-based formulation that the big institutional investors contribute their data to, is they've marked down the value of hotels 23%, of retail projects 10%, but for apartments and office, they're basically slightly down, and for industrial, up. So this just gives you a perception of where we are in the large institutional markets. We do have, as the next slide shows, a surge in delinquencies, and this is for CMBS. It's in both retail and lodging. But other property types are relatively stable at this point. Bank data shows that the banks are being so far forbearing, but I say so far. And again, their issues are retail and hotel. The next slide shows you that there's been a pause in investment sales. Through, again, September, we've had a big slowdown, roughly 50% in investment sales compared to last year. People don't react as quickly to changes in markets as they might. But my guess is that as we move through the next year, there'll be a lot of opportunities, which we haven't had in a while, to buy things 10, 20, 30% cheaper than we were before. But that is true for hotels and retail and maybe some office. Probably not going to be true for most apartments, unless coastal apartments, and certainly not going to be true for industrial properties. So if we can look at the clock, this is the way we summarize things. Where are we in the business cycle? This is supply, demand, vacancy rates, and rents. What we find is that certain categories are doing great. Life science real estate, single family for sale, grocery-anchored retail, industrial properties, and many B and C properties in southeast and southwestern locations. The property types are showing the biggest drop in rents and vacancy rates. Biggest rise in vacancy rates are the retail sector, hotel sectors, and coastal high-end apartments. In terms of rent collections, the next slide just shows you very good rent collections for every property type except retail. And, of course, that's consistent with where we are in the fundamentals. So I think we'll come to the next polling question.
Okay, so the final polling question of 4 to get CPE credit, need to answer at least 3 of these. What regulatory changes concern you the most? Is it what's going on at the federal level, state, local, all of the above? So while we're doing that, just a quick reminder, please submit your responses. And at this point, we have a few Q&A questions, but we're getting closer to that section, so please get some questions in for us to respond to, for anyone that has questions. About 75% complete on the polling question, so we're almost there. And then just a quick heads up, Ken, I know we had talked about moving some slides around. I think some slides may have come up next. If we, depending on how you want to progress through this, we could pass over those and then circle back to those.
Yeah, I think we should pass over the next 3 and go to renter households as a portion of total households. It's about 4 slides down. It's slide 52.
Perfect. So I think you want to go to this one.
One more.
One more?
Yep, one more. Thank you. No, one back one. Sorry. We're doing all this remotely, as you know. Now the next one. Okay, so we're going to do rental housing. We're going to go each property type quickly before we get questions. So we had a trend of the proportion of people as renters had been falling for the 3 years before COVID struck. Since COVID struck, this data shows that the proportion of people who are renters has fallen dramatically. But what's happened here really is that people have moved home with their parents. So if we look at the next slide, I think that really tells you what's going on. That roughly 2.5 million people have left their rental units, especially in East and West Coast, and moved to cheaper markets or moved home with their parents. So now 52% of young adults are living with their parents. Shocking. The parents want them to be gone and can put up with it for a while, and the kids want to have their own place. So once we're back at work, once COVID's done, need to be back in the office, and once the recession ends, we think we'll see the resurgence of the apartment demand by young adults. Next slide shows you we are going to see less production of new units. We think that's already happening, and the annual rate of production is down to 250,000 in the August data, so that's going to happen. And the next slide shows you the good news is the apartment market is started in a very good place. Vacancy rates were very low when it started, 30-year lows in many cases. And the markets are really bifurcated. The next slide shows you overall rent growth has stopped, but it's really market by market. And the next slide just looks at the data year over year from September. And so at the bottom of the chart, you see places like Silicon Valley and New York and Boston and L.A., obviously effective rents down, free rent. At the top of the chart, though, you see a number of cities where people are moving to, whether it be Phoenix, Charlotte, the Inland Empire, Atlanta, Dallas, Salt Lake, and they have rent positive. So I think it's really a bifurcated world, and investment community knows that. The next slide just shows you multifamily returns have slowed because there's some capital losses that we're seeing in the East and West Coast markets. And I think the next slide is really important, that the trend moving away from high-tax states, New York, California, Illinois, New Jersey, Michigan, had already been going on before COVID. This was all before COVID. COVID accelerated this. And where are people going? The next slide just shows you Florida, Texas, the Carolinas, Arizona. So this has been happening, and this is all before COVID. COVID just made this happen more dramatically. The next slide just shows you a mistake that we have. This administration has decided to prevent or eliminate international legal immigration. We know they were against illegal immigration, but now they've cracked down and stopped all international legal migration. So the numbers show up in a big way. Already before COVID, COVID has stopped us even more. We may not realize this, but 40% of our population growth comes from legal international migration. A lot of our key entrepreneurs and startups come from these great students who come and stay here. So we need to think about that policy. Businesses generally want legal immigration of high-skilled people. We need to keep that happening. Now if we go to the office sector, we've done the cover slide, so let's skip to the next slide, which is construction. We had quite a bit of construction, but nothing like the previous booms when we started all of this. And the next slide just shows you job growth plunged in the office sector, has rebounded some. However, people are not going back to the office. The next slide just shows you this, that people have been working from home. But it also says 70% of the people want to go back to the office. This is of employees. And it shows that more flexibility, working from home 1 or 2 days a week, or maybe 3 or 4 days a week, is desired by some substantial number of employees. But the reasons to return to the office really are in that box, that the coordination and collaboration, creativity, casual interactions that come from office settings is important. Career guidance and mentoring, especially for younger, new employees. And employers want control. So I think that once COVID's dead, it will take a while. There'll be more flexibility, but we will be working back to the office. We call it better together. But vacancy rates have already been moving up before COVID and moved up further at the moment. And as I said, occupancy is very low at the moment. People haven't gone back to the office yet. The next slide just shows you, if we can go one more slide, one more slide. The next slide just shows you that last year the big leasing areas were tech and co-working. This year, co-working, of course, is giving back space. Tech has slowed down, and so we've seen leasing 50 or 60% below anything we've seen before in terms of new leasing. And it has resulted in the next slide, the amount of sublet space surging all over the country, but especially in places like San Francisco and Seattle. San Francisco is just a huge increase in sublet space. Same thing is now happening in Manhattan. People are realizing they didn't need as much space as they thought, and so they're putting that sublet space on the market. And total returns, the next slide, have obviously been weak in the office sector. Small write-downs so far. But again, it depends on the market. We now switch to industrial, and let's skip the cover slide. Let's go to the next slide, which is basically the growth of trade. This is the 20 equivalent units, TEUs, which are the big containers, and we're up 10% year over year. There's weights to get into our ports now. So that is a very big statement. The recovery shows up in imports. Next slide just shows you new constructions down a little bit from where we were before, but much of the constructions is for Amazon-like fulfillment warehouses. Next slide just shows you that absorption has not quite kept up with construction, and so as the next slide shows, the vacancy rate has edged up a little bit, but it's still very low, close to a 50-year low here. And so returns on industrial, the next slide just show you year over year still up 10%. So this sector is still very desired marketplace. Next, we go to retail real estate, and we can skip the cover slide. We've done that one before. Construction's at very low levels. And the reason is the next slide, that we have new supply coming from store closures. We have record store closures this year. We have large numbers of bankruptcies, and in a bankruptcy, of course, you're able to disavow your lease. So this is a huge problem overall for the sector. And the vacancy rate is surging. The next slide shows you that, and this is even for the best quality regional malls. And what's going on is cannibalization. The next slide just shows you that this has been going on for a long time. The trend has accelerated. E-commerce, which is the gray line here, is surging. Internet sales, department stores, very few are going to make it over the long run. And so I think that is the nature of the business. It's been happening for a long time. This e-COVID shutdown has accelerated that phenomena. And returns for retail are negative already. Again, a write-down of almost 10% in the value of assets. So if we can next talk about what do we do in this environment? Well, as a lender, I think this environment is very difficult. You've got to stress test each loan. You've got to be patient, give forbearance. It's hard to get that sometimes. So it's a difficult environment. Be very careful. Investors, which many of you in the audience are, there's lots of opportunities. First time in a while we've seen this. You can basically, the demand side dislocation and disruption has provided opportunities to buy very different property types at big discounts to replacement cost and big discounts to pre-COVID pricing. We haven't seen it yet, a lot of the transactions, but I think we're going to see more of them. I would also take advantage of this debt environment and lock in debt either through capital market techniques or directly. There could be substantial tax law changes in 2021, and one of the slides earlier had that, but I'll just tell you what they are. There's talk, if we had a Democratic blue wave, of eliminating the 1031 exchange, raising capital gains tax from 20% to 39.6%. There's basically talk of possibly lowering the inheritance tax threshold and eliminating the step-up in basis. So there's a number of tax things that could change. Again, your client person at Moss Adams can help you figure that one out. It may not happen, but it might happen in early 2021. Probably doesn't take effect at 2022, but they could do retroactive to January, so you just don't know. Anything you underwrite, though, I'd want to underwrite for a 2 to 3 year recovery, and I think that's important. And I think the ability to buy vacant space in strategic markets, to do adaptive reuse, to reposition assets, I think it's a very exciting time. So I know we want to leave about 10 minutes for questions, and so I think we'll stop at this point. And I know we've got some questions, so we'll let Kelvin be the moderator on the question side.
Okay, Ken, I think you covered all the tax implications and reform questions that we skipped over.
Yeah, I think one thing I did forget to mention, and maybe if we can switch back to the slide If we can, it's slide 50. I did want to talk about California. That was a mistake not to do that. California is trying, if we get to slide 50, that I think that's, yes, thank you. One more back, I think. Let's see. No, one more forward. It's state and local tax issues is two more forward, I think. You can move it. Yes, that's it. So we are trying our best in California to kill the goose that laid the golden egg. And we have two big tax provisions on the ballot, or real estate-related provisions on the ballot. One is the split roll attempt to tax commercial real estate at current assessed values starting in 2022 rather than at the historic value plus 2% a year. And that could double or triple property taxes. It's called Prop 15. We also have a rent control provision on Prop 21, which would end vacancy decontrol. Right now, under Costa-Hawkins, when a unit becomes vacant, you can raise it to market. Again, Prop 21 would prevent that from happening. There's also, in San Francisco and other places, propositions to double transfer taxes in Proposition I in San Francisco. There's been legislative proposals in Sacramento to put a wealth tax on, to put increased income taxes on. So I do think the tax environment for real estate, both in California and nationwide, is going to become less attractive. Real estate is immobile. Raising property taxes is a way to close those budget gaps. So that is, again, a worrisome thing. So that is, I forgot to mention that, Calvin. So we can go now to questions. I apologize.
Yeah, no problem. Thank you. Clearly there's a lot going on with these budget deficits that could be very impactful to the economy, and there's a lot of uncertainty that our clients are concerned about. So a couple of questions here. Some relate to, I'll try to cover office. With occupancy so low right now of people using space, and a lot of press happening around migrations of people and companies out of higher tax, higher density places. Any thoughts as far as what the demand will be for office in the cities versus suburban markets, kind of longer term as this plays out?
Yeah, I think that we have to be very careful of judging what the post-COVID regime is going to look like. Pre-COVID, we had people wanted to be in New York and San Francisco. The young tech workers wanted to be there. They were booming. Now that's all turned around. And if work from home becomes a central part of many companies' strategy, and we've heard many tech companies talk about it, they may want a more diversified workforce outside of just some of the core markets, and suburban hubs might become more attractive. But I think we don't know yet. Let's see what happens when COVID's done and see how people react. I still think people are going to want the agglomeration economies of cities. But I would say on net, it helps suburban areas and it helps Sunbelt locations and low-tax locations, which were already benefiting before COVID.
Okay, assuming there is no vaccine in the near future, and with all the second waves and just the continual waves and potential like opening up and shutting down to control it, do you think we are headed towards a more severe depression?
Well, if we don't contain the virus and we shut down things again, we could have a recurrence of the recession. I think we're going to coexist. We're going to let the virus run and coexist, and people are adapting to it. That's where we are today. But it's possible we may have no choice if it really gets out of control in certain markets. Don't think we'll have a national shutdown. But I think that the virus control is critical to the recovery, and if it causes reversion, that could create a recession. A depression is not likely. Depression is something that lasts for a long period of time, and I just don't see that happening. Because viruses, not only vaccine might work, but they also play themselves out. If you look at what happened in 1918, 1919. 3 waves, it was awful. Equivalent of 2 to 3 million people died in the U.S. compared to today was actually 650,000 died. 50 million people worldwide, but it did die out. So I'm not thinking depression, but I'm thinking if we do get a big second and third wave, and we could see a slowdown and some reversion.
And kind of on the same thought process, read a lot about the migration out of the density areas. The stat you showed earlier, 70 people want to go back to work for all the different reasons. I mean, in some of this is, as normal. It takes a while before the data really comes out. Longer term, and actually I was on a panel or listening to a panel in the last week where certain folks in the Bay Area office market were speculating that, hey, there is a fair amount of people that have already gone back to the office because they just want to. They want to get in. They want to have all those benefits. Longer term, how big of a percent do you think will migrate to more of a working from home perspective versus wanting to be in? That, I don't know if there's any statistics on that, but we've been through terrorist attacks and other things in the past, and yet, Manhattan rebounds and comes back to be the place that we all know and love.
Yeah, well, I'm betting that the rebound happens. I call it better together. Just our little companies that we have, it's hard doing stuff remotely. There'll be more flexibility. But before all this happened, only 4% of people work remotely. Now we're somewhere close to 85 to 90%. But I think we're going to go back to a more traditional pattern. I think this is COVID. But I think there may be, instead of 4%, it may be 15%. It might be 1 or 2 days a week, more flexibility. But I think the office is still here to stay, and I don't think it's fundamentally going to change. And once COVID's gone, we'll take mass transit again. We'll take airplanes again. We'll do all the things we did before. That's my best guess.
Switching property types, on the industrial side, clearly it's been a very good property type for investment purposes the last few years, continues to be so. Do you think it's getting close to peak?
No. I think the industrial penetration of the market, e-commerce, is about 20-25% in the U.S., and it surged the last 8 months, I'm sorry. And once we get back to more normal life, there'll be a pause. But I think overall, it's the system that people like. And I think a lot of older households have learned to use it during this crisis. So I think that your retail is going to have to be really experiential retail. That's where we're going to get people out there. But I think and people have learned to pick up goods rather than shop. So I think this is a long-term trend that probably accelerated too fast. There'll be a pause. And industrial could be overbuilt, but I don't see that happening in the near term.
Okay. Switch to apartments. Question about rent concessions. And do you think we're reaching a point in the pandemic where maybe concessions are peaking out? Or do you think that's maybe further down the road?
Well, I think that in the coastal markets, we've seen actually some pickup recently in leasing and the like. So as people return to the office and get their jobs back, I think we'll see more of that. So we may have bottomed there. But what worries me is the unemployment compensation, the supersized stuff, had kept a lot of people, especially low and middle income people, be able to pay their rent. As that is now ended or ending, that's going to create a hole. And this moratorium meant that many people may have had back rent due, and when the eviction moratorium ends in January, they may not be able to have that back rent. So I think we have an indigestion period, so we're probably not at bottom yet. It's because of the lack of new money coming out of Washington. If new money comes out of Washington and the virus is tamed, I'd say that we may have hit bottom, but I think probably another 6 months down the road before all those things have happened.
Great. Well, we have met the hour mark. I want to thank everybody for joining us today. Thank you, Ken, for joining us and leading the discussion. You know, Rosen Consulting Group and Moss Adams really appreciate everybody tuning in. So with that, have a great day.
Thank you, guys.
Thank you, everybody, for attending today's session. For more information on Moss Adams, please visit mossadams.com. And for more information on the work of Ken and the Rosen Consulting Group, please visit rosenconsulting.com. Momentarily, a webcast survey for your feedback will be popping up in your web browser. We'd appreciate any kind of feedback you'd like to provide, and we look forward to seeing you at another session for this year's Building Opportunity Conference. Thank you again, and have a great day.